Good afternoon, everyone. A warm welcome to our webinar on input tax apportionment. I'm pretty excited today particularly for two reasons. One is that we have collated some very interesting case studies on this topic. And secondly, and most importantly, I'm co-presenting with my colleague and team member Aalap, who has been with me for almost since 2017. So cheers to that. Moving back to the topic, input tax apportionment has been one of the most neglected areas in VAT compliance by most of the companies. Again, for two reasons. One is that most companies assume that they don't have any expenses directly in relation to exempt supplies, and therefore input tax apportionment does not apply. And secondly, what I've seen is that the FTA has, by default, given expense ratio as the standard or a default method for calculating the input tax apportionment. However, if you look at UK, India, Saudi, or for that matter, Bahrain or Oman, the default method which has been prescribed for input tax apportionment is the output-based method or turnover-based method for calculating the input tax on common overheads. So before we, so if FTA wants to increase their VAT revenue and increase their VAT revenue base, then this could be one of the low-hanging fruits where they can just simply make an amendment and have output-based method or a turnover-based method as the default method for calculating the input tax on common overheads. Okay, so before we start the presentation, some housekeeping rules. If you have any IT issues, please write to us on the chat box and our IT team should be able to help you. And if you have any questions so please post them in the chat box and we will be happy to take them in the Q&A session. And last but not the least, webinar is being recorded and will be shared with you on our YouTube channel later. So yeah, you can refer that if you require it in the future. Okay, moving on to the next slide. So today's agenda is in 4 parts. The first part is understanding what is input tax apportionment and how is it to be calculated, and then discuss some of the annual adjustments that you have to make in your VAT return at the end of the year, and then we'll take up some industry issues and prior clarifications that we have got in our consulting firm. So, and last but not least, we'll take up a Q&A to take up your questions, and we'll be able to answer them if time permits. So yeah, that's how we have prepared the agenda. Moving on, so I'll hand over the floor to Aalap to explain you and just make you understand what is input VAT apportionment.
Thank you, Geet, for setting the pace. Before I start, let me just give you tell you about a small interaction that I had with one of my friends this morning. So he called me and he said that I see that you guys are doing a webinar on input tax apportionment, but this has been there since day one, as in it's not something new, as it's not something where there are recent changes or developments. So why now? And I thought that many of you on this webinar would have the same question in your mind. And to answer to that, I just said one thing to him, which I would say to you, every one of you, is that after this webinar, I'm sure you will find or learn 5 new things which you would not have known prior to this webinar. So stay excited for that, and I'll take you through that. So let me start the webinar in my first part of the presentation about the basics of input tax apportionment, and subsequently I will take you through the technical aspects. So the first question is, why input tax apportionment? Okay. In the UAE or anywhere, any businesses would generally have 2 types of supplies: taxable supplies or exempt supplies. There could be businesses which have only taxable supplies. There could be businesses which have only exempt supplies, and there could be businesses which have both taxable and exempt supply. So input tax apportionment applies to those kind of companies which indulge in taxable as well as exempt supplies. Now, there are common misconceptions which are there in the market, where we've seen over the years that many industry players feel that since they are not primarily into one of the exempt businesses, like real estate, residential real estate leasing, or financial services, or local passenger transport, or bare land, sale or supply of bare land, input tax apportionment would not apply to them. But this is a misconception, because during health checks and assignments that we do for many of our clients, we've seen that every business typically has some kind of exempt supply which they would be doing, and they have not identified it as an exempt supply. So just to give you some examples, companies giving intercompany loans to their subsidiaries or their related parties earn some interest. This interest is exempt under VAT. It could be the same for employee loans as well, where you've given an employee a loan and you're earning some interest. The second one is quite interesting, which is sale of shares, which we have seen that most of the businesses do not record as exempt supply in their VAT return. We have had a private clarification to this effect also, that the actual value of sale of shares should be reported in the return as exempt. The third one, again, in the past 5 years, every time we see a health check, this is our favorite point, we see that labor accommodation in lieu of housing allowance is not reported as exempt. To explain this in a detailed manner, basically, if you have an employee with a salary of say 10,000 dirham, and it's a breakup, the salary has a breakup. Say your basic is 3,000, your DNS is something, and your housing rent allowance is say 3,000 dirham. Okay, and you give the employee an option that instead of house rent allowance that we pay to you, they give you a company accommodation. Now, what happens is the employee opts for the accommodation, and then in the salary, this 3,000, which is the HRA, is deducted. Now, this is clarified in the guide that this is an accommodation that you're giving to the employee in lieu of housing allowance, and this should be reported in the return as an exempt transaction. Similarly, transportation services, local transportation given to employee and amounts recovered from employee should be reported as exempt. So many businesses have actually missed to consider these as exempt and therefore never thought about the implications of input tax apportionment. So regular businesses doing these kind of exempt supplies could also have the implications of input tax apportionment. So we urge businesses to first identify such transactions, first come to know what is the exempt supply that you're making, and then you think about the input tax apportionment angle. So this is why. Next, we come to what is input tax apportionment. Like I said in my previous slide, businesses which are doing resident exempt as well as taxable supply typically have three types of expenses. One is expenses which are directly attributable to taxable supplies. One is expenses which are directly attributable to exempt supplies. And the third, which could be common, which you cannot directly attribute to one of the two supplies. As you all are aware, input tax towards taxable supplies is fully recoverable. Input tax towards exempt is not recoverable. And for the common portion is what the apportionment is done. As in the actual value, recoverable value of the VAT on common is what is the apportionment, is the allocation of common cost between taxable and exempt. I will explain this with the help of an example in my subsequent slide. Like we do in accounting, there is a cost allocation which is based on man hours, capacity utilization, revenue, or profit. Similarly, under UAE, the method which is standard prescribed at the first instance is the expense ratio, where expenses towards taxable activity is divided over expenses towards taxable and exempt activity, and then you come at a recovery percentage, which is to be applied to a common overhead. And then you figure out the actual recoverable portion of that on a common overhead. This is like Geet explained in the previous slides. In other countries, generally it's output method. UAE is an exception, which gives the expense ratio. So here, one point that I want to highlight to everyone is that it's very important that you bifurcate your expenses correctly. We've seen in refund cases and audit cases where the FTA asks for the apportionment calculation, and then they point out that this expense you have classified as common, and this expense you've classified as fully taxable towards taxable. Why? And businesses should be able to respond to that. We've seen that we have changed for some of the clients, we have changed the apportionment calculation because this query has come and the position has changed. But I think this is a one-time exercise which every business should do who's engaged into taxable and exempt, and correctly classify the expenses that you generally incur into these three buckets for your apportionment calculation to be correct. Okay. Next is how do you do apportionment using the standard method. So this slide is basically numbers, how do you perform the working, what exactly percentage you come to, and how do you apply it. So in this example, the company is into real estate leasing business. It has income from commercial leasing and it has income from residential leasing. Now it has three type of expenses, three buckets. One is input towards exempt activity, which is residential building, input towards commercial activity, taxable activity, which is commercial building, and input which is common, which is head office expenses, audit expenses, IT infrastructure cost, something which is common, which you cannot directly attribute. Now, how does the apportionment work under a standard method? So for the residence related, which is 500,000 in my example, it is completely ineligible because exempt, it's towards the exempt supply. For commercial building, it is fully recoverable because it's towards a taxable activity. The third, which is the 700,000, the common. Now this has to be apportioned basis the standard method, which is input towards taxable activity divided by input towards taxable and exempt. In my example, this is 1.2 million over 1.7 million. When you do this recovery percentage, whatever result you get, in my example, 70.59, this has to be rounded off to the nearest whole number. In our experience, we've seen that generally this round off many people miss, and the impact is less for certain companies because there's not much to apportion. But for huge companies like in real estate, we've seen that this round off could actually result into tens and thousands of input back reversal. So so in my example, the 70.59 gets rounded off to 71%, and 700,000 into 71% is 497,000. So out of the 700,000, 497,000 is your recoverable portion of common value. So in this return, if these are the only transactions, my total recoverable VAT in the return would be 1.2 million plus 497,000. Next, we come to the type of adjustments that we are required to do, and when basically this answers when do you need to do the apportionments. The first one is tax period. Each tax period for a business into taxable and exempt has to apply the standard method on a tax period to tax period basis. Basically, you use the numbers of the tax period, whatever expenses you've incurred, you bifurcate into three baskets, and then you apply the standard method, and then whatever is the recoverable amount that you report in VAT column. So here we have seen many taxpayers not reported correctly. They use the adjustment column. So typically, a business which has a tax period wise apportionment, has to do apportionment, will have taxable value, say 10,000 dirham, and the recoverable VAT amount in box 9 would not be 500, would be lesser than 500 because the VAT is apportioned. So the standard method has to be done on a tax period basis unless a special method is approved by the FTA. Now, this special methods I will explain in my subsequent slides. So on a tax period basis, this is the calculation that you're supposed to do. Then we come to annual. Now, annual, there are two types of adjustments. The first adjustment is the wash-up adjustment. Wash-up is nothing but true up of the calculations that you have performed on a tax period basis, true up to the annual number. So basically, you do the same thing that you've done for the tax period wise, but using the annual number. And when do you have to do this? You have to do this in the first tax period of the subsequent tax year. For the full past tax year, you are supposed to do it in the first tax period of the next year. Many businesses sometimes ask us that when will it be our tax year? This can be easily identified when you log in on the portal. You can see on the RFTA portal, you can see that your tax year is defined. It could be different for every taxpayer, depending on when you got the registration and what is your tax periodicity. So for the annual wash-up adjustment, first you do the true up. Once you do the true up, you compare the true up value as in the annual value with the what you have actually recovered in your each tax period. So to give you an example, if I do an annual calculation and say my recoverable amount is say 800, and on a month-on-month basis, it is I've recovered 100, 200, 300. So the difference between those two amounts has to be adjusted in box 9 adjustment column. It could be a positive adjustment as well. It can be a negative adjustment, but this true up has to be done. This true up, this wash up has to be done irrespective of any method that you're following. As in, even if you have a special method approved by the FTA, you still have to do this. So this is mandatory. There's no limit, nothing. Even if it's a 10 dirham difference which is coming on an annual calculation, you still have to make this adjustment. The next adjustment is the use-based or a actual use adjustment. Here is when special methods come in. So the FTA has prescribed 4 methods, which I will be discussing in the subsequent slides. Here, what you have to do is the annual wash-up adjustment that you've done, the figure that you've computed using the annual numbers standard method, you have to compare this with the special method, which could be which is applicable to your sector, and compare the difference between the input between the two. If the difference is more than 250,000, positive or negative, you need to make an adjustment. And if the difference is less than 250,000, then no adjustment. So here, this special method application, many businesses have missed in the past years, and because of multiple reasons, which I will explain in my subsequent slide. So yeah, so now I'll just explain the 4 methods of special methods that are prescribed by the FTA. The first one is output-based method. So this method typically applies to financial sector. Here, basically, the idea of this method is that there should be a strong correlation between your income and expenses. As in, the more expenses that you have, the more income you generate. So if you are into a business and you feel that the special method, the expenses that you incur are linked to your income, then this is the method that you have to apply. The method says that taxable supplies output divided by total supplies. Total supplies include taxable, exempt, and non-business. So this formula has to be applied to your VAT on common overheads. The next one is typically for real estate businesses which are into commercial and residential leasing, where it is possible to identify the floor space of the taxable activity and your exempt activity. So in this case, you need to first get the floor space, and then based on the floor space, you need to come at a recovery percentage. So it's a floor space used in taxable activity divided by the total floor space. The third one, which we generally don't see many businesses apply, is where the expenses are linked to the number of transactions. So here, there is no correlation between the value of your supply. It could be 100,000, it could be 500 dirhams. But my expense is just linked to the number of transactions that I have. So this is taxable transaction count divided by total transaction count, and then you arrive at a recovery percentage. The fourth method is sectoral method. This is typically for large businesses, say a tax group with 20 entities, a conglomerate, where every entity has a different kind of business, different business. So for example, if a group has residential as well, financial as well, some retail as well. So each sector has to apply the method that is applicable to them, as in which will give the most fair result. And then using the residual expenses of that particular sector. So just to give you a stepwise analysis, first you need to do a residual allocation for each sector, then apply the percentage special method percentage for that sector. Now, apart from these, there could be some expenses residual which do not apply to each sector and at a group level. For those expenses, the FTA has given 2 methods. One is a headcount method, which is number of employees in each sector over total employees in the business, and the second is output method. So, yeah. Next slide is my common errors which we've seen in input tax apportionment. So over the past few years, and these errors we see repeatedly. The first one being the recovery percentage round off. Like I explained in my previous slides, this can have an impact of 500 dirham to 20,000 dirham. Many people don't do it, miss it, but this has to be done. The second one is annual wash up as per standard method, not performed where there is a difference of 250,000. Now, many people have this misconception that the true up of monthly to annual level should not be done when there is no difference more than 250,000. But like I said in my previous slide, this is compulsory. The true up has to be done irrespective of any method that you're applying on a tax period basis. The third one is application for reapproval. So for businesses who know that for them to give a fair and reasonable result on input tax, on common input tax, they will have to apply a special method eventually at the end of it. They have an option to apply to the FTA for use of this method on a tax period by tax period basis. So many businesses in 2019 have actually applied for this because they don't want to take the hit of this apportionment at the end of the tax year and in the first tax period. They want it to be apportioned on every tax period basis. So for such businesses who have applied and who have received an approval of a special method to be used on a tax period basis, for sectoral method, the approval is only for 2 years, and for other methods, which is output, transaction, or floor space, the approval is for 4 years. So businesses who would have applied in 2019, probably they are now due for a reapproval, as in an application for reapproval. So the guide says that you need to apply again, apply to the FTA again for use of this special method. So for businesses in 19 or sectoral method, people who are using the sectoral method, they need to immediately apply. The fourth one is calculation of special method not performed since it is not prescribed for an industry. So typically, we've seen that many businesses feel that, okay, I'm in the real estate sector or the education sector. Why should I use a method which is not prescribed? As in the methods, special methods that are prescribed by the FTA are not are industry-based, industry-wise allocated, and not for us. But that's not true. We have received private clarifications for some of our clients where a retail sector or an education sector is advised to do an output method because the standard method does not give a true and fair view, a fair and reasonable result. So the misconception that it does not apply to every business, a special method cannot be used by every business is incorrect. The next one is again a recent case that we've seen where some businesses in 2019 or 20 have started using the special method on a tax period basis without seeking approval from the FTA. So here there are two things. One is if you want to use a special method on a tax period basis, you need to apply to the FTA that give me an approval to use it tax period basis. The second thing is when you do the annual wash-up adjustment, you need to use a special method which is applicable to your sector, as in where you feel that the result would be reasonable. So many businesses have used the special method on an each tax period basis without seeking approval. In one of the case that we've seen, the FTA has asked that file voluntary disclosures for each tax period and actually do the adjustment on an annual level because you did not seek approval from the FTA. So this is one of the case. And the last one is the reporting error, which I explained earlier, that for a tax period basis, the apportioned input tax should be reported in the VAT column. And for an annual basis, it should be in the adjustment column of box 9. So I think this is the last slide that I'll be presenting. From here on, my colleague Geet Shah will be taking you over some important case laws, some important private clarification insights, and I'm sure you guys will find it interesting. Over to you, Geet.
Yeah, thank you, Aalap, for that understanding on the input tax. I think that was quite clear. Okay. So in terms of the industry issues and prior clarifications, just want to give a disclaimer before we start that it's the prior clarifications that we're going to discuss are fact specific and they are specific to the client to whom it is issued. So therefore, it will not be applicable to each and every company, but a reference can be taken from these issues and the prior clarifications which have come and take a position accordingly. So with that disclaimer, let's start with the issues and we can have a poll question as well on this and to just make it more interesting. So the first case study that we want to bring in is the yacht berthing area. There is a company which has a mixed use development. There is one commercial building and there is a residential building, and it also owns a yacht berthing area where yachts can be parked. Now, when we do a input VAT apportionment calculation, the question was whether these berthing area, including the territorial water where the yachts are parked, can be included in the floor space calculation. And the reason why this issue came up was because if we include that area, the calculation was in much favor of the company, and therefore this question was come up. Now, so to get an answer, I'll just put a poll on this and see if some of you can answer it. Yeah. So for this particular issue, if somebody could answer on whether the company can actually take the yacht berthing area and territorial water into the calculation for floor space method. We have 41 votes. Once we get at least about 50 votes, then we can show the poll results. Okay. So 52% of the participants have said yes, the yacht area, the parking area should be covered in the floor space calculation. And there are about 48% who have said it should not be included. So just to give you an answer to this, when we took the FTA clarification on this particular issue, we had stated in the facts that the yacht area, the parking area that has been with the company earns a rental income. So they earn a rental income from all the yacht owners for that particular area. And therefore, the company believed that it should be included in the floor space calculation. While one could argue that the formula is for covers only the floor area or the land area where the property is situated, but this is a seabed. So how can a seabed be included in a floor space calculation? But the advantage of the company, FTA gave a positive response with the fact that yes, you can include the berthing area, including the territorial water, in the floor space calculation, which was quite favorable in the for the company. Okay, moving on to the second case study, compensation type payments and receipts. So the fact is that a company is into taxable and exempt revenue, and they also receive payments such as penalties and fines, and also get receipts such as grants, donations, sponsorships, and disbursements. Now, if these kind of payments are received, whether one should include these payments and receipts for arriving at the recovery ratio under the output-based method. So let's have a poll again on this and get your views on this particular issue. Yeah. So if you could answer this particular question and give your views on whether one should include these compensation payments or receipts in the output-based calculation. Okay, so 40% of you have said yes, that should be included in the output-based calculation. And there are about 60% who have said no. And the right answer is yes, it should not be included because just so we are yet to get clarity on whether these payments or receipts should be included. But in our view, these payments or receipts are not supplies. These are out of scope, and technically there is no supply which is being made by the company. And therefore, this should not be included in output-based calculation. Because if you look at the formula, it talks about supplies. And these payments or receipts, compensation that we receive is not a supply, so to say, and therefore it should not be included. So, yeah. Moving on to the next question. There is a group with a holding company and there are subsidiaries under it. And typically, what we have seen is that in these type of arrangements, a holding company provides loans to the subsidiaries and earn interest income. So the fact is, yes. So the question here is that when a holding company is providing intercompany loans and is earning interest income, whether it has to compare the calculation of input tax apportionment under the standard method and a special method using output-based method. So let's have again polls on this and get your views on what do you think should be the right answer. So 72% of you have said yes, it should be, the interest income should be used and should be compared, the calculation should be compared as per standard and special method. And there are about 28% who said no, it should not be, the special method should not be used. So the clarification that we got on this particular issue was quite surprising one. And even we thought, same as the 72% attendees, that the holding company should do a output-based method calculation to arrive at the input tax apportionment. But in the clarification, we got a response from the FTA that since there are no direct expenses which are related to the loans, it is not necessary to apply output-based method. And the standard method is more likely to give a accurate recovery position, and therefore you may not undertake a comparison between standard method and a special method. So this is quite an eye-opener that we received through this public clarification. Okay, now moving on to the fourth case study. So there is a group which is into a beverage business, and it has Bearland as one of its assets. And during 1 year, they sold those Bearland to a third party. Now, when we do this annual input tax calculation, whether the company should use a special method and arrive at the input VAT apportionment, and if yes, which method should be applied? Again, let's have, so the answer here that we got from the FTA was that since it's a one-off exempt supply, FTA accepts that this will not impair your standard method usage, and therefore you may not calculate your input tax recovery through the special method, and you continue to use your standard method for apportioning your common cost. But any expenses which are directly in relation to the sale of Bearland, which could be agency fees or legal fees, will not be recoverable. So that's the case that we came across. Moving on to the last one, let's say there is a group which has 3 business divisions. One is oil and gas, second is a retail, and third is investments. And on one fine day, they decide to sell off the retail business division to a third party. And on the transfer, there is a consideration received for selling that particular division. So since this transfer will qualify as a TOGC, and whether and it will be out of VET scope, whether this should be included in the output-based apportionment calculation. Again, the clarity is yet to be awaited from the FTA, but we believe that TOGC is not a supply, and therefore apportionment of common cost should not apply for consideration related to TOGC. But any direct expenses, let's say legal fees or consulting fees, which are incurred for doing this transfer of business as a going concern, should not be recoverable. With this, I'll come to the last part of my slide in terms of understanding the concept of apportionment under UAE corporate tax. Now, we discussed the UAE VAT apportionment. Even under the UAE corporate tax, there will be an apportionment that companies have to do. Now, to just give an example, a free zone company would have a qualifying income and a non-qualifying income. So the qualifying income would be subject to 0%, and the non-qualifying income would be subject to 9%. Similarly, a mainland company would have income from business operations which are subject to 9%, but there could be certain dividend and capital gains which are subject to 0%. Now, in these cases, companies will be required to apportion their common cost into the 0% income and the 9% income. So if you look at section 28(3) of the CT law, it clearly says that the deduction of the expenses will have to be made, but there will be a bifurcation that companies have to do. One is the direct costs, which are directly in relation to the 9% taxable income. And secondly, for common cost, only a portion of expense will be allowed on a fair and a reasonable basis, similar to what is given in the UAE VAT law, where companies are required to apportion their cost based on a fair and a reasonable basis. Even under the CT law, companies will be required to apportion their common cost between the 0% income and the 9% income. And though in the CT law, they have not specified what are the methods to apportion the cost, but depending on the facts of each business and the circumstances of each business, one could use one of these special methods which have been prescribed under the UAE VAT law to arrive at the common cost bifurcation. Now, with this, we conclude our presentation. Let's take up some of the questions that you have posted on the chat box and see. Yeah. Okay, so Aalap, there is one question on what about the input tax apportionment in case of large tax groups? Should we apply apportionment on the whole group or only on the real estate part of business? So yeah, Aalap, if you could answer that.
Yeah, so in case of large tax groups, first you need to identify that for each sector, each business that you have, what are the residual expenses? If, say, for example, I have a real estate business and the real estate business has commercial leasing and residential leasing, first I need to identify what are the common expenses of that sector towards residential and commercial. And then you apply the float space method for that part of business. Similarly, if you have another business which has some other common overheads, you need to first identify that and apportion it basis the method which is prescribed for that business, which could be output method generally. And then only the common portion of the expense, which is residual for, as in not residual for the sector, but residual for the entire business, that has to be apportioned using the sectoral method, which is headcounts or outputs.
Okay.
I hope that answers your question.
Yeah. Okay, so the next second question is, how do you know when you have to apply a special method? So I'll answer that, Aalap. So at the end of the year, when you do your annual calculation and you compare, you have to do a comparison between standard method and what are the numbers, the annual numbers which are arriving based on the standard method, and then you have to apply one of the special methods and apply it on the annual numbers and see the difference and see the comparison between what are the annual numbers as per standard and vis-a-vis what is the annual number as per your special method. And if the difference is more than 250,000 dirhams, then you have to make an adjustment for the differential amount in the VAT return in the first VAT return of your next year. So currently in February, when you're filing a return for January 2023, you have to do an annual calculation of your 2022 numbers and then see if there is an impact which is more than 250,000 and then make an adjustment. Okay, moving on to the next question. We need to compare.
Yeah, sorry.
Yeah,
Go ahead.
Take it on. Yeah.
Yeah. So there is a question that do we need to compare standard method and special method for wash-up calculation, even though the special method is not approved by the FTA? The answer is yes. So for the annual wash-up calculation, first you do, like I explained, first you do a true-up of your standard method which you applied on each tax period basis. The annual number will then have to be calculated, will have to be compared with the number that you are getting using the special method. And if there is a difference of 250,000, yes, you need to do it. Even though you have not applied for a special method, the application for a special method is when you want to use that method for a tax period basis. Like on every tax period, you want to apply for a special method. I hope that answers.
Okay. Okay, the next one, how can we apportion the cost of elevator of a building which has residential and commercial leasing? So again, the cost of elevator can be based on the, as the Aalap discussed about the floor space method. One is you do it based on standard, and then based on the floor space, you take your square meters of your commercial part and your residential part, and then arrive at the input tax related to the cost of elevator, and see what is the percentage coming in, and then you apply it.
There is a question that is sale of shares part of consideration for exempt. So sale of shares is exempt, as in the actual value of shares, even if you have made a profit or a loss. If you have sold shares of say 10,000 dirhams, it is an exempt transaction and has to be reported in the return. And expense related to that sale of share would be blocked because it is exempt. And then you have to see if there are any common costs.
Yeah. So again, then in Bahrain, there's a clarification on sale of shares where it is specifically stated that you only need to report the profit or the loss as your exempt supply. But contradictory in UAE, when we obtained a prior clarification on this particular issue on whether a sale of shares, do I need to report only the profit or the loss related to this supply, or do I need to report the entire value? And the answer that we got from the FTA was that you have to report the full value of your sale of shares as your exempt supply. So yeah. Do we need to post common input VAT in separate GL while booking expenses, or can we book both direct and common input VAT together and make an adjustment based on tax period and apportionment? See, Naushad, I think the question, the best way to do this is that you bifurcate your expenses into three parts. One is your direct cost related to taxable supply, one relation to exempt supply, and then you have a residual cost, which is your common overheads. And then do the calculation using your taxable versus exempt supplies. So we would suggest that when you are doing accounting your cost, you should bifurcate these expenses into three parts so that you can have a better visibility on what is the impact of input tax apportionment. Okay. Can you share the webinar along with Q&A? Sure, we will do that and we'll share it with you after this. By tomorrow or by Monday, we should be able to share the webinar recording as well as the answers to the Q&A. I think with this, it's already 3:45. We have finished with the time slot, and thank you for attending this webinar. It was wonderful to have you, and it was a good the questions that have been posted are quite interesting. So thank you very much.
Thank you very much, everyone.
Okay.